Okay, well, good morning, everybody. Welcome to our webinar. I'm delighted today to be joined by Nimesh Patel, who most of you will know as Senior Tax Manager at Grunberg Co. So welcome, Nimesh. And we're joined today by our guest speaker, Mike Deakin from ABFL. This webinar is all about funding and finance and really what happens when the flow of government funding stops and what your business options might be going forward. So as with webinars we've held before, if you're familiar with them, we will have time at the end of the session today for a Q&A. I'm happy to take as many questions as you're able to give us in the time that we've got allowed. If you're used to using Zoom, you'll be familiar with the Q&A option on your toolbar. If you're not, if you look on your toolbar, you'll see Q&A. If you just open up that panel, it allows you to put your questions forward and we will try and answer as many of those at the end of the presentation as we possibly can. Okay, so at this point, I'm going to hand over to Nimesh, who will also introduce Mike officially, and we'll take questions as I say at the end. So over to you, Nimesh.
Thank you, Jo. So very pleased to have Mike Deakin here today. He's a commercial lending specialist who I've known for quite a while now, and he's been in the industry for over 40 years. So we just thought it'd be very useful to have his expertise, his know-how, his experience, because obviously now that the government funding has started to phase away, we're looking ahead and we want to make sure that businesses are looking forwards and not just thinking about what's available in the present. Mike is a useful asset to have here because he'll be able to explain what businesses can do going forward when the government funding stops. So next slide, please.
Okay, thanks very much. Sorry about that slight sound error there on the slides. I hope that the next sort of few minutes is going to give you an idea of what's available and what's not. And I wanted to give you some background. My background, very briefly, is that I've run several finance companies. I worked in the city when I first started financial services over 40 years ago. I've been an underwriter, I've run businesses, I've seen both sides. I've been poacher and gamekeeper at different times. I've been running my own business now for nearly 13 years, and I get involved in a whole host of deals for clients both in the UK and overseas. So the market is very fluid and very, very diverse. The issue is that a lot of people don't really understand how fluid and diverse it is until now, when we're faced with a pandemic that no one has faced in peacetime. So hopefully the next few minutes will enlighten you a little bit. Next slide, please. So my background, currently I'm a director of the National Association of Commercial Finance Brokers. It's the biggest trade body in the UK, nearly 30 years running. All of our members are FCA regulated, so we have 2,100 individuals, 1,100 firms and 138 lending patrons. My own business is fully regulated by the FCA. So basically what I have to do is give best advice and treat every customer fairly. Next slide, please. What I wanted to do before I go into detail is talk about the overall lending market. And this is from the latest Bank of England Financial Stability Report published in August. And you can see over the last few months how pre-pandemic, in the year pre-pandemic, money raised through the markets goes through a fairly steady course. Money raised is not sort of particularly cyclical unless there is a particular element of growth or opportunity. But you can see what happened when lockdown took place. Suddenly, cash flow was starved. And in March and April in particular, banks were inundated, and I use that word very, very deliberately. They were inundated with requests for money. And the government did step in with its coronavirus protection schemes for businesses to provide debt solutions, which the government would partly support through interest payments and potential performance guarantees, which has been largely taken up by millions of businesses. That has continued, thankfully, through the extension of the applications through to the end of November, and money to be drawn by the end of this year. So there's still time to get the money. It's needed. The second wave proves that it's needed, and it's there designed to protect jobs and save businesses across the UK in all sectors. Next slide, please. So what sort of commercial finance is available? And I'll let the viewers read all the products that are available, but let me focus particularly on the last two. The Bounce Back Loan Scheme and the Coronavirus Business Interruption Loan Schemes and the large CBILS schemes have been widely taken up. Nearly 1.4 million businesses have taken up a Bounce Back Loan or a Coronavirus Business Interruption Loan. We're talking at the moment, currently over £35 billion has been raised through this particular support scheme. That's on top of the furlough scheme for salaried staff. It's a massive injection. It's something which has never been done in peacetime, where we've reached a level of national debt which is the greatest it's ever been in the UK's history, and it surpasses the wartime debt levels in World War I and II. That's how serious COVID has been to the UK economy. You all know this, but for a lot of businesses, the question is, well, where do I get it from? And after a very sort of hurried start because of the nature of the pandemic, a lot of lenders actually join the government support schemes and provide a welcome portal for money to be raised by businesses. But it works on the principle of looking back to go forward. Everyone has to basically qualify by being a robust, solvent business as at the end of December 2019. That particular parameter still remains the same when you apply for money. And the key is going to be how you succeed in managing that money and how you succeed saving your business. So the money will still be made available, but the question is, well, what happens in 2021? Next slide, please. So what does happen next? So where do you go to find money when the coronavirus schemes finish? There are, as you saw in the previous slide, I have access to over 600 lenders. There's probably even more than that. The lenders range from private lenders to institutional lenders to smaller banks to some of the sort of newer online and digital banks. They all have a solution for a particular commercial finance problem. And I'm excluding the residential mortgage market from this conversation at the moment, because that market has a very different dynamic. But inexorably, it's linked to commercial finance for the simple reason: if you don't have a job, you can't afford your mortgage. So commercial finance is the cornerstone of everything that we do in the UK, and it's really important. So the answer is, there are plenty of places to go. You just have to be able to be presenting your business in a positive light and showing everything that you've gone through in the last 12 to 24 months, in the good times, in normal trading, and in the more challenging times that we face this year, okay? So the question about, are you growing or need better cash flow? The question is really, have you got cash to survive? And will you be able to grow once things become more regularized? And I'm not saying normal, I'm saying regularized. So that leads on to other questions. Are you going to need that money in the next 12 months? So the likelihood is that you probably will. And I've included in that particular third point, development finance. The government is very keen to build Britain better. That's one of their slogans. And part of that is linked to the construction industry. The construction industry is one part of a very complex part of the way in which the economy is interlinked. But building is a cornerstone for a lot of other industries. And as a result, it gives people places to work and places to live. But in order to have the opportunities to take advantage of that, the construction industry relies on the rest of the economy. That's really important. So a lot of smaller businesses just don't have the time, money or resource to be able to go and find the money. So that's why using regulated commercial finance brokers like myself, as well as your professional advisors such as your accountants, are really important. You've got to ask them the questions. How do I solve my problem? How do I solve my cash flow issues? So the last point I made on this slide is, do you have the time to source the finance? Are you just too busy? Most people are actually busy. They're either busy taking advantage of COVID, because there are winners in this, not just losers, or you're busy firefighting, trying to basically stave off the next rates demand, the next rent demand, the next set of wages. How do I do my furlough? There's loads of things that your accountant can support your business with, but at the same time, it doesn't alleviate the core problem, is where's the money coming from, which is why these schemes have been put in place to protect the economy. It's the biggest rescue package ever seen in peacetime in the UK. Next slide, please. So, what I'm really looking for, what I do myself when I'm talking to clients, I have to actively listen to them, okay? So some of the points are positive points and some of the points are negative points. So the first 5 bullets on this particular slide are all positives. And believe it or not, there are industries which are absolutely thriving right now, really thriving. A lot of online and digital businesses are thriving because they were already set up this way to cope with, doing work in a new digitally facing environment. But there are others equally that are facing big challenges, especially in interpersonal businesses, whether you're in arts, music, hospitality, leisure, personal services, anything of that nature. That is really where issues happen. So running through those points very briefly, you could be taking on new staff. Possibly you are, if you're running a supermarket or a delivery business, you're going to be taking on more people. Customers are paying their invoices even later than they were previously. That's a way of releasing cash flow. There's funding available for that. You want to buy a business or downsize, or maybe buy another business, and those with cash will be buying other businesses because there are opportunities to grow. You'll need to buy new equipment. I have clients at the moment who are looking to expand their business internationally during COVID because they've got product which works for them. They need to buy manufacturing equipment to grow. So, I'm being asked to help raise money for them. So, as I say, it's not all doom and gloom, but it's a question of where to find that money, because a lot of the traditional lenders at the moment are stuffed full of COVID-based loans. And their problem is they're getting indigestion. They need to be able to digest it properly. Some have urgent bills to pay. Now, HMRC has been good. They've given people time to pay, and they've actually deferred things like VAT. They've basically relaxed the rules and temporarily suspended them in terms of late filings for Companies House. They've also given people assistance in terms of, if you like, other grants and supports. So if you're really up to your limit and you're indebted to the bank and you've given them debenture security or personal guarantees and you need additional short-term cash, there are lenders out there, not cheap, who can provide that support for you. So you need to just think more laterally and think, well, who do I know that can actually help you? Some people just want a few invoices financed. They don't want to go through the rigmarole of setting up a dedicated invoice finance facility. And there are people out there who can actually fund individual transactions. And some just need money to survive. And they may have equity in their properties if they're small owner managers of their businesses. There's a lot of, for example, there's a lot of convenience store owners who are doing really well at the moment. But the problem is they're finding that their cash is a bit strained because sometimes their business is it's not as regular as it was because people come in at different times because of the way we're living. So these are all things you can do to listen. That's what I have to do when people approach me for funding. I have to listen to where their pinch points are. It could be positive or negative. Next slide, please.
So thank you, Mike. That's a very useful insight into what we could be looking at going forward. I'm sure there's lots of options which simply businesses aren't aware of. So, if there's anything on there that in terms of what to look out for various scenarios, then obviously Mike is the person to contact in terms of just getting the right advice and understanding better, what your options are. So thanks for that, Mike. What I want to do to finish off is to give you a brief overview of two schemes which have been around for quite a while. And they're not to do with borrowing money, it's to do with actually raising investment for businesses. So basically investors who want to put money into a business to acquire the shares in the business. And this is actually quite a popular scheme with our clients as well. So I thought it'd be useful to actually go through the brief benefits of these schemes, because they could offer an alternative way to raise money in these times. So if we look at what do we actually mean by SEIS, the Seed Enterprise Investment Scheme, and EIS, the Enterprise Investment Scheme, we can basically simplify it by looking at this diagram here. So we have two components. On the left-hand side, we've got the company. So this is the business that needs to raise the money. And provided they meet various conditions, so for example, for SEIS tax relief, the company can't have been trading for more than 2 years. For EIS, they can't have made their first commercial sale more than 7 years ago. Otherwise, they have to meet additional criteria. Other criteria are the company has to carry on a qualifying trade. They also need to have a UK business as well. So on the left-hand side, you can see the company will raise the money, and then they'll use it to spend money on things like hiring staff, possibly research and development, marketing, perhaps pay rent on their premises, basically just to cover the running costs of the company whilst it's in a startup stage. And then on the right-hand side, you have the investor. So the investor will put the money in. And why will the investor want to put money in? It's because they can obtain tax relief on the investment they make. And they also need to meet various conditions. And the most important condition is that they can't have more than a 30% stake in the business. So this doesn't work for individuals that want majority shareholding. It is aimed at those that have smaller shareholdings, hold shares as an investor rather than being the main person in the business. So move on to the next slide. So what are the benefits to the company? So what we find is that those companies that have got approval from HMRC that they qualify for SEIS and EIS, they tend to find their companies are more attractive to investors. So they're more likely to raise money from investors compared with if they didn't have this approval. And basically the main reason is that the investor can get tax relief on the investment, which means the risk they're taking to buy the shares in the company is offset against the reduction in their income tax bill. Obviously, they can raise money to start off a business, or it may be that the business has been running for a few years, but they need to take it to the next level. So they may need additional funding to take it from certain profitability to make it, upscale it to what their goals are. So maybe they want to, increase profits by tenfold, for example. Then they may need money to actually help them actually expand the business. Like I said, they could possibly recruit more staff, increase marketing, the kind of things that you need to do to actually upscale the business. And also the other benefit is that the business can actually meet its expenses because the investors are providing the cash flow. So obviously without the investment, who's going to actually be paying for the company's expenses during the startup stage? It's normally the directors and the other shareholders. But here, by having this scheme, more investors can put their money in. So you've got more source of funding for the day-to-day expenses, which obviously the way things are at the moment with the economy, that would be a welcome boost to many businesses. So next slide, please. So I've explained that there's tax relief. So the first type of tax relief is income tax relief. So what do we mean by income tax relief? Well, it depends on which scheme the investor has made their investment under. So we talked about the SEIS scheme. So that applies to companies that haven't been trading for more than 2 years. So obviously those are more risky investments, and that's why, as you can see, the investor can claim 50% income tax relief on the investment. So basically, if we look at the example on the left-hand side at the bottom, the individual has, say, invested £50,000 into a limited company that qualifies for SEIS. And what that means is that they can actually reduce their income tax bill by up to half the amount invested. So their income tax bill can go down by £25,000. So when we look at actually what have the shares cost the individual after getting the income tax relief, those shares only costing them £25,000, which means straight away they can afford to lose £25,000 on that investment. So that's how SEIS income tax relief works. And it's quite similar for EIS income tax relief. So the rate of income tax relief is 30%. And what that means is that on the right-hand side at the bottom, you can see a 50,000 investment means that the income tax bill for the investor would go down by 15,000. So that's 30% of the 50,000 invested. So the net cost of the shares after claiming income tax relief is 35,000. So as you can see under both schemes, the investor has a bit of a buffer in terms of what they can afford to lose on the investment. So next slide, please. So what are the capital gains tax benefits? Well, if you make an investment under SEIS and you have made capital gains in either the same tax year as the investment or the previous tax year, then you could actually reduce your taxable capital gains. So if you look at the left-hand side at the bottom, so we've got a £50,000 investment. So for every pound invested under SEIS, you can actually exempt half the amount, so 50 pence of capital gains. So for somebody who's invested £50,000, they can exempt up to £25,000 of capital gains, which have, being made in the same tax year as the investment or the previous tax year. So what that means is that once you reduce the gains by £25,000, if you assume the gains would have been taxed at 20%, then the capital gains tax payable by the investor has gone down by £5,000. So in addition to getting the income tax relief, they're also potentially reducing their capital gains tax bill as well. For EIS investments, the rules are slightly different. So rather than exempting an amount of capital gains, you're deferring capital gains. So if we look at the right-hand side at the bottom, we've got an investment of £50,000. So for every pound invested under EIS, you can defer £1 of capital gains. So in this example, they can defer £50,000 of capital gains, which means they've deferred, if you assume the rate of tax would have been 20%, they've deferred £10,000 of capital gains tax. And that capital gain will be deferred until the EIS shares are disposed of. So if you don't sell the EIS shares, the capital gain deferred won't come back into charge. So next slide, please. So obviously we mentioned the benefits when you actually make the investment. There's also benefit if you dispose of the shares, and if you dispose of the shares for a gain and you've held the shares for over 3 years, then the capital gain made on the shares is actually exempt from tax. And if you have made a loss, then you actually have the ability to either set the loss against income, or you can offset the loss against capital gains. So you have that flexibility compared with other types of losses. So if we look at the example below, so we've got an individual, their taxable income before taking into account any losses made is £200,000. So this person, they're an additional rate taxpayer, so they pay tax at the 45% rate. Now, if they made a loss on either SEI shares or EI shares, and that loss was £50,000, then that would, on their tax computation, when they do their tax return, the £200,000 will be at the top of the computation, and you will deduct £50,000 from the income. So the taxable income actually goes down from 200,000 to 150,000. So you've actually reduced the taxable income by 50,000, which means that the actual income tax payable for that year will go down by 22,500, which is 45% of the 50,000, which has been knocked off the taxable income. So as you can see, that's quite a benefit to investors, because if they do make a loss, the amount of tax relief they could get is actually potentially much higher, because if you offset the loss against capital gains, you can only get loss relief at a maximum of 28%, whereas if you offset the loss against income, you could be getting 45% tax relief. One thing to bear in mind is that if you sell the shares or dispose of the shares within the first 3 years of holding the shares, then the income tax relief might be withdrawn, so the initial income tax relief claimed. However, if you receive nothing when you dispose of the shares, because perhaps the company has gone under and it has no value, then you will retain all the income tax relief you claimed. If you do get money on a disposal of shares, then the amount of income tax relief that you will have to repay to HMRC will depend on how much you got. If you sell the shares within 3 years and you actually recoup all the money you invested, then all of your income tax relief will be withdrawn. So what we have to do there is think, well, if we've withdrawn the income tax relief, the actual loss that we've incurred is actually reduced by any income tax relief withdrawn. So when you calculate the loss that the person's made on the shares, you have to look at what did they receive, deduct how much they paid for the shares, but also add back the income tax relief that they've kept. So for example, if you had a situation where the shares are sold at a loss, they held the shares for over 3 years, so they've kept all their income tax relief. When we calculate the loss, we actually add back the income tax relief that they've kept, because the true loss made is actually after the claim of income tax relief. So there's just that bit of a nuance to bear in mind there. Move on to the next slide, please. So yeah, thank you for listening to us on the SEIS and EI scheme. And if you've got any questions and answers, then please feel free to post them.
Great, thank you very much, Nimesh. Thank you very much, Mike. We do have a couple of questions that have come in. First one for you, really, Mike, in terms of planning for 2021 and planning funding and finance for 2021. I guess kind of what happens next question. What's your best advice?
Okay, it's a good question. The best advice I would give to people is actually to plan now. We know what's coming at the end of the year, which is all support really is going to realistically stop as far as debt finance is concerned. So the question is, what's going to happen in 2021 to your business? And if you plan now, it's the best way to deal with the problem. There are lenders to suit every requirement. And I would urge people watching this webinar today to take serious note of the fact that if you go to the bank says no, it's not the end of the solution, it's the beginning of the solution. Because you can actually approach many other lenders that will find a way to help your business, even when things are not looking great. There are many sound businesses that have been really adversely impacted by COVID. But equally, those businesses want to survive, they need to keep jobs, and they have an exit strategy, which is when things do get back to a more regular situation, they will be able to thrive. So I would say the way you need to approach this is to actually seek the advice of your accountant, but seek the advice of a good commercial finance broker with broad reach. What they will be able to do is horizon scan the market for you and find the best solution. Sometimes that might mean only going to one or two lenders, because some borrowers are very nervous. They may have already approached many people and not got success. And the idea of using someone independent that's regulated is that what they'll do is find out who they've been to not approach them, and try somebody else they've never thought of that will actually give them the solution. And that can be for any size of business, whether you're a small business that's looking to grow or survive, or a larger business that's got scalability but doesn't have the cash because their banks or their current lenders are not helping them. There will be a credit crunch next year. Money will be harder to get. I won't say it'll be more expensive, it'll just be harder to get. And the reason for that is because the lenders are looking at the core of your business, which is affordability. Part of the coronavirus loan scheme requirements is to basically plan for 3 years ahead. So when you submit your application, you have to produce a 3-year future financial forecast based on what you believe at the time is realistic and based on the performance of your business up to December 2019. Because that's the cut-off benchmark for which coronavirus loans over 50,000 are measured. So you've got to believe in your own business, and you need to be able to articulate that story in a way which allows a lender to be comfortable enough to say, yes, I believe in you as a management team, I believe in your business, I'll lend you the money.
Okay. The question that follows on from that really, Mark, from Jeremy, which is, would commercial lenders lend to the hospitality industry, for example, restaurants, who were doing very well before COVID, but now obviously finding it impossible to trade properly?
That's a great question, Jeremy. And the answer is yes. There are specialty lenders that I work with who do nothing but lend to the hospitality industry. They provide funding for people with short-term leases. They also provide funding for people who are in particular sectors. They're not sector sort of particular. So they will look at sort of mixed-use hospitality venues, which are sort of part accommodation, part restaurant. They'll look at nightclubs and other ventures. Also, a good source of funding for a lot of hospitality businesses are leasing companies, because they fund the fixtures and fittings in those businesses. There's also lenders that will fund the short-term rents for sort of short-term leases in a separate way. So the answer to your question is yes, there will be money available for it. The bigger question is, will they be able to survive on what they've got now? That's the real problem, because without footfall, a lot of those businesses are going to suffer, and it's about survivability. And that's, in a way, what a lender always looks at. And, you know, when a lender lends money, they look at the history to see what's going on, but the history's been disrupted. So they've got to look at the people, and they've got to look at the location, and they've got to look at the survivability of that business based on where it is, where it's located, and what their future is.
Okay.
And that's really hard to predict.
Okay, thank you. The question here for you, Nimesh, on the scheme. What's the approval process? Is that an application to HMRC? Does that have to be done for you?
Yes, so that's actually something that we can do for the company. So the idea is that what we encourage businesses to do is to get pre-approval before they raise investment, that the company qualifies for the scheme. The reason being is because if the investor has already put the money in, later on down the line, HMRC don't agree that the company qualifies, then it can put the company in a very difficult position with the investor. So we always recommend that the company gets pre-approval. So it's a process where we submit an application. It's a detailed application. We have to send them the business plan, cash flow forecasts, details of the investors that are going to invest, various other information. If the company has previously done accounts, then we need to produce those as well. So it's quite an involved process, but the main benefit is that the company has more certainty before they actually raise money.
Okay.
Investors.
Okay, thank you. Okay, well, that brings us to the end of our questions, the end of our webinar. As usual, we will make a on-demand version of the video available on the website later on today, and everybody who's registered to attend will get an email with a link to that. So thanks very much, Nimesh. Thanks very much, Mike. Most informative, and we look forward to our next one. Thank you.